what we're going to be going over here is available for sale securities as a discounted bond, and we're going to look at the amortized, the adjusted fair value, and any unrealized holding or gains or losses on this available for sale security here. So for example here, Corporation A purchases a 9% bond. It has a $300,000 maturity value on the bonds here, and they're purchased at 98 3/4, or that would be 98.75% of par, which equals the purchase price here of $294,750. And they were purchased here on 1/1/X1. They're going to mature in 3 years. They pay interest semi-annually, and they're classified as available for sale security. So that's the key that we're going to be looking at here in this example. Now, here we have to determine the fair value. So the fair value is going to be at the end of each year. That's at 12/31 at the end of each year, and we're going to be looking at 3 years here, and it's going to be shown in our amortization schedule. Okay, so let's go down and let's first off here, the bond as available for sale security, and we'll just abbreviate that as AFS here. And that, where you look at the amortized cost versus the fair value of the bond here to determine any unrealized holding gains or losses on this available for sale security. And we're looking specifically at a bond here issued at or purchased at a discount. Okay, so let's go down and look at what we're talking about here. So when you're dealing with these bonds, you're going to have to set up some type of amortization schedule. Here we're going to be looking at just the effective interest method here. But when you're dealing with these available for sale securities here, what you're going to have is two things you're going to have here. You're going to have to be comparing the fair value, and that's at the end of each reporting period here, with the carrying amount, or what they would call the amortized cost here, in this case on this bond. And what you're doing here, you're comparing that, your amortized cost with your fair value to determine if there's any gain or loss. And those are going to be unrealized gains or losses here. Okay, so let's start with our amortization schedule first here. So in this case, we purchased this bond, and we're going to receive those cash payments here for the interest payments. So what we would have, that was that 9% bond, semi-annually divide that by 2. You're going to have 4.5% here, semi-annual interest payments times the $300,000 worth of bond. So you're going to have 6 cash payments you receive here of $13,500 each. This is on a semi-annual basis here. Okay, so the next thing we have to work with is our interest revenue here, and that's based on the yield rate of this bond. And for this example, the yield rate wasn't given, so we're going to go and we're going to calculate that now. So this is where we're going to use our financial calculator here, and I've got the buttons on the calculator laid out here, and what you're going to have to enter here. And what you're really wanting to do is you want to match your interest rate here to the period of that for the payment periods of that bond to determine the semi-annual interest payment, or the yield rate on a semi-annual basis, since this bond is paying on a semi-annually here. So first off, for the number of periods here, your N button, well, you had a 3-year bond, 2 semi-annual payments, so you got a total of 6 payments. Enter that as 6 here. Now, interest, well, that we're going to calculate here, but next we deal with the present value of the bond, and that was, you enter that as a negative amount here, $294,750, and that's what we calculated up here, 98 3/4% of the 300,000 here. So enter that as a negative amount, present value button. Now for your payment, that was the cash payments that we're receiving here, $13,500 we have here. Enter that, and then the future value here, your button, that's the maturity value on this bond, $300,000. Okay, so then enter all those numbers here. They hit your interest button here, your I button, and you're going to come up with effective interest rate here of 4.8431%. Okay, so now to determine our interest revenue here semi-annually and our amortization of this bond. So you take the carrying amount here. We got the $294,750 here. That's what we paid for it. And we're going to amortize it up to $300,000 here. So we'll start with our carrying amount, what we paid, the $294,750 times that yield rate here that we calculated. Take that times that percentage of 4.8431%. And you're going to get interest revenue here of $14,275 for the first period. Compare that to your cash received here, $13,500, and this is going to be your amortization amount here, the discount, $775. Simply the difference. You add that to the beginning carrying amount here, $294,750. You get your new carrying amount here, $295,525, and just proceed on with it for your amortization. Take your yield rate here times your new carrying amount, and there you get your interest for the period. Compare that to the cash receipts, and then that would be the amortized amount. The next amortized amount, add that to your beginning carrying amount here to get your new carrying value for the period here, and that's what we call the amortized cost. So when we get this amortized cost here, this is where we're going to be comparing it to the fair value here. So looking at our first year here, X1, we've got our amortized cost off our amortization schedule, and we're going to be comparing it to the fair value. And we're going to be doing that for each of the next 2 years here. Year X2 here, we'll be doing that, and year X3, making that comparison to determine if any, and they're going to be unrealized holding gains or losses. Okay, so we've got our amortization done here, and let's just say our fair value was given here. So now let's go and look at how we'd record this. Okay, so moving up here for recording this here. So we're going to start with this bond here. Now what you would do is under these bonds here, you would list them under the title here, available for sale securities here, and as a bond here, and then we're going to have some cash receipts here, and then we're going to have some interest revenue here. But what's tied to this available for sale bond here is going to be a fair value adjustment account here for this security here. That's going to be tied to it, and tied to our fair value adjustment here, we're going to have some unrealized holding gains and losses in an equity account here. So that's what we're going to be looking at in this problem. But we'll start with our normal entries that we'd make for the bond here. So available for sale, you just debit that here for the payment amount that you made here, and that's when you bought it, when you purchase this bond here, $294,750. Debit your available for sale securities under the bond here, and then the credit would be for your cash account. That's what you would have paid. You reduce your cash account by that amount. Okay, so then your other normal entries, all you do is you take those for your cash, those semi-annual interest payments you receive, that 4.5% interest payment, $13,500. You got 6 of those. Debit your cash for that here, and then for your available under your available for sale security in your bond, that's that amortized discount. You just list that, debit that here for the amortized discount for each period here, and then moving over to the interest revenue. This is the actual what you record on your income statement. This is the actual interest revenue that you would be realizing, and that was based on that effective yield rate here of what I got, 4.8431%. So though you just credit that here for each of the on your income statement, just credit it for that revenue that we calculated, and all comes off the amortization schedule, all of these things. So your credits here to your interest revenue are going to balance with your debit entries here to your amortized discount here, and also the debits here to your cash account. And then when the bond matures here, you would just remove it off your available for sale securities account. Just in this case, the maturity value was $300,000, so you just credit it out here, and then you would have received cash here for a $300,000 debit, or increase your cash account here for $300,000. Okay, so now what we're really going to get into is with these available for sale securities, we're going to get into this fair value adjustment here account, and also the unrealized holding gain or loss account here, and we're going to go through that. So we'll start with our fair value adjustment account, and that's going to be a valuation account here based on this available for sale security. So what this thing is here, we're not going to, when we make our adjustments here, they're not going to be done directly to the available for sale account here for the bond. What we do is we separate it out here. We use a valuation account, and we make our adjustments here. But any increases in our fair value adjustment directly would increase our available for sale security account, and same for any decreases here would reduce our available for sale account here. So that's what we're told, that valuation account. Okay, so now And then the other thing is you do not report any changes in the fair value here in your net income until selling the bond here. So there's going to be changes going on here that are going to go into a gain or loss account here that's unrealized, but holding gain or loss. But none of those get included in your net income. They're going to be sitting here as part of equity here on the balance sheet. And we'll get into that here. But what we have to do is we have to make these calculations here for this fair value adjustment. So this becomes, you got to watch it very carefully here. So let's go down here and look at what we're doing. So this is where we're going to set up our yearly, what we're looking at those 3 years here, those end of X1 here, year X2 and year X3, and we're going to have to determine what they call the unrealized gain or loss here based on the fair value of this bond versus its amortized cost. So you just lay it out in this fashion here. List your years here, and then your amortized cost, that's going to come off that amortization schedule here. And then again, the fair value, we had that listed here along with our amortization, but that has to be determined for each of the end of the period reporting here. And then we're going to be looking at the case here. We'll compare our amortized cost here, that's that carrying value of the bond, to the fair value at that reporting period, and the difference is going to give us what they call an unrealized gain or loss here. So let's just go through our first year here, looking at the end of year X1. So if we look on our amortization schedule, we're going to get our amortized cost here at $296,338, and then the fair value at that reporting period would have been $297,800. So you can see the fair value here is greater than our amortized cost. So this is where we're going to get in this case, an unrealized gain here of $1,462. Simply the difference here. Fair value is greater than the amortized cost. Okay, so now we've taken care of year X1. So now this is where we have to get into our detailed calculations here. So looking at the end of year X2, amortized cost $298,083. Again, compare that to the fair value, which is $292,500. So our fair value here is less than the amortized cost. So we have a loss here. We're carrying it at a greater amount here on our amortized cost. Our cost amount here amortized is greater than the fair value. So we're going to have a loss here. Difference is $5,583 here. Simply the difference here. But now this is where the trick comes into this fair value adjustment here. So this you're going to have to watch a little carefully here. So what we have $1,462 in our first end of the year for year one, the balance here. So you can look at it in terms of debits and credits in any one of these accounts here, the fair value adjustment or our unrealized holding. But say you got a debit amount here of $1,462, and we have to get down to what we have here, the difference, this loss amount here for year X2 here. So the only way we can do that is you just look at your debits and credits. We need to get to a $5,583. That's the end of year X2 balance in our accounts here. So the only way you can do that here is you got the debit, or let's say you got in this case you could have the credit amount here in unrealized holding and gains or losses. You have to get down to the balance that you need here, $5,583, and the only way you can do that is by putting a debit amount here, in this case in our unrealized holding gains and losses, by $7,045. So we got, looking at the positive on $1,462 and the spread here to $5,583, so you're going to need $7,045 here for your fair value adjustment here. And if you've gone up to your account here, we'll just look at our fair value adjustment here, debited that here for $1,462. That was at the end of year X1 here, and then the end of year X2, we had to credit that here for $7,045. And you can see this is where we'll get into it. We'll look at the unrealized holding gain or loss, and again, that's an equity here account on our balance sheet. We'll get into that, but our credit here, whatever we have in a debit here, we're going to be crediting over here in unrealized holding gains and losses, and any credits here goes in debits here. Okay, so we've taken care of our adjustment here for a fair value adjustment here for year X2. Now we have to get into our fair value adjustment here for year X3. So again, we just look at year X3, the amortized cost here at, let's say, a maturity value here of $300,000, and the fair value at that date here was $297,200. So you can see our fair value is less than our cost, so we're going to have an unrealized loss here of $2,800. But now for our adjustment account here, this is again where we have to go in and look at our debits and credits. We have $7,045 in the X2 balance, so we can just go and look at it up here. We've got that in the balance here, but we need to get to a balance here of $2,800. Now we're not showing the $2,800 up in these accounts, but in order to do that, we're going to have to make an adjustment here, add to our, in this case, look at unrealized holding gain here. We're going to have to add $4,245. So to get, we're sitting here at $7,045. We got to get to a balance here. When I say a $7,045, that's a negative amount here, and that would be a debit here to our unrealized holding gain or loss. But we have to get up to essentially a loss here of only $2,800, and the only way you can do that is add to it. In this case, you would be crediting your unrealized holding gain or loss by $4,200. So I hope you see the math that goes in, the tricky little math that goes in here. You just have to use a little logic. So that's how you determine your fair value adjustments here. So let's go back up to our accounts here. So for our fair value adjustment, you can see what's going on. Coming right off our calculations here. Debit for the year X1, that was pretty easy to figure, simply the difference between our cost and our amortized cost and our fair value. So we had a gain here of $1,462. So you would debit your fair value adjustment to available for securities to our bond by $1,462. That's at the end of year X1. And then we would credit unrealized holding gain and loss as an equity account here on the balance sheet. Nothing went to the income statement. Everything's sitting on the balance sheet here, and that's part of shareholders' equity here on our balance sheet. Nothing goes to the income statement at this point, and it would be part of other comprehensive income. So this unrealized holding gain and loss. It's part of shareholders' equity on the balance sheet, but it would be listed under other comprehensive income. Okay, so we've taken care of that here for that first year here. But we want to make a point here. This fair value adjustment, this $1,462, the debit amount here, that actually, instead of entering our adjustments directly into our available for sale securities account, we use this valuation account here. And so that debit here actually increases, debit already increases our available for sale security as well here. Okay, so going back down here for this fair value adjustment here for year X2 here into $7,045. So we had unrealized, in this case, we had that adjustment here for a loss. So we credit or reduce our fair value adjustment for that loss amount here, or adjustment here for that loss here, $7,045. And then our unrealized holding gain, again, equity on our balance sheet, we debit that here for $7,045. And then the final year here, same thing. We just take our fair value adjustment here, that $4,245. So that would be a debit amount here, since that would be an unrealized, the adjustment we have to make here is an unrealized gain here. So debit your fair value adjustment account for that amount here, and then the credit would go to unrealized holding gain here, equity account here, $4,245. Okay, one last thing here before we go into any further here. And now, if what we want to look at here, now if this bond here was sold before maturity, all you do is take the amortized cost at the sale date here, whatever, take it off your schedule, your amortization schedule here, and then you would compare it to the selling price here, whatever your selling price is, and then you'd get any gain or loss. So if your amortized cost here is greater than your selling price, then you're going to have a loss here. So then this is where it comes into the income statement. Any gain or loss for the available for sale security would be recognized at that time on the income statement, only when it's sold here. But let's just go back up here one more time here, so just so we understand what's going on here. So just looking at our accounts here. Just remember, when you're dealing with these available for sale securities, in this case we had that bond, you have to set up a separate account here, and that in that case that's where you isolate out, in this case, your amortization costs on that bond here, and whatever cash you had to pay for it and whatever cash you're receiving, that would be listed over in your cash accounts here. But the security itself here, and its amortization, is separated here from this fair value adjustment. The fair value adjustment, remember, is a valuation account here, and that has to be separated out here from the security, accounting for the security itself. And then when you have, in the case of these available for sale securities here, you're going to have an unrealized holding gain or loss, and that, remember, is part of equity, part of shareholders' equity on the balance sheet here. It doesn't include any income statement accounting at this point. It's just considered as other comprehensive income under shareholders' equity and as an unrealized holding gain or loss. And then the other thing is, just remember here, working with that schedule here, just remember you have to look at your amortized cost for each of those reporting periods, compare it to the fair value, and there's where you get any unrealized gain or losses that you'd have to calculate. But then your adjustments are all based on what's previously sitting in your accounts, and you have to make your adjustments depending on those debits and credits that we talked about here. So you just can't go haphazardly, and you have to go and use a little bit of logic here to what you have in your balance and then what you need to get down to, and then that's where your adjustment would be. So that'll end our discussion here on these available for sale securities, and here we looked at it as a bond that really had to be amortized.